Good afternoon, everyone, and thank you all for joining this webcast for fixed income investing. I'm Payal Parikh, and I'm a senior tax manager in Private Client Service Group at Mazars, where we always seek to understand our clients and their requirements and focus to serve as their trusted advisor. I primarily work with high net worth individuals, partnerships, and businesses with their tax compliance and tax planning. I'm joined by Wilson Lee. Wilson?
Hi, everyone. My name is Wilson Lee. I'm a senior in the Private Client Services Group here at Mazars. I also work mainly with high net worth individuals, families, and executives in the areas of tax compliance and planning. Our private client group provides customized service and solutions, working closely with our clients and their team of advisors, such as BNY. In today's constantly changing market, I believe there's always a need for advisors, and I hope to speak or work with many of you in the future. From here, I'll pass it back to Payal.
Thank you, Wilson. As I work with high net worth individuals, I often see different clients with different investment strategies or portfolios, right? And as we talk about investments, we all know we have had a tough year. Equities and bonds are both down year to date. In fact, equities have had the toughest year in a long time. Volatility has been extreme, but the thing is, it could continue for the next few months until the path of inflation is much more clear and how the Fed will bring the inflation down to deal with the fact that it's at a 40-year high. So I'm very excited today to have John Plehai with us. John is the head of fixed income for BNY Mellon Wealth Management. He's responsible for all fixed income strategy, policy, and management on assets totaling more than 30 billion. He's chairman of Bond Strategy Committee and is a member of the Investment Strategy Committee, Investment Policy Committee, and Asset Review Committee. That's a lot, John.
Yeah,
John has more than 30 years of investment experience and has been an investment manager with the firm since 1994. John, thanks for joining us today.
Thanks for having me.
All right, so before we start, we just want to launch a general polling question for the room. So you'll see something pop up on your screen. So just please, when you get a chance, answer that. All right, so let's get into the first question. So John, how did we get to where we are today? And what's the current status of the bond market?
Yeah, that's a good question. To really answer that, I think we need to roll back the calendar and remember what happened in late 2021. Remember, in the third quarter, you had a Federal Reserve that, while they saw some shoots of inflation, thought it was going to be transitory. But by the fourth quarter, they recognized that it wasn't going to be transitory, and they did a bit of a 180. And by the end of the first quarter, had gone from an easing of monetary policy to tightening monetary policy. Inflation was continuing to accelerate, not only globally, but domestically. And so, just like many central banks around the globe, our Federal Reserve began to aggressively increase short-term interest rates to try to choke off inflationary pressures. So it's really all about inflation. They have moved rates from close to zero for short-term interest rates to overnight rates to now are just below 4%. And it looks like they're poised to even go another 1% higher. So pushing short-term interest rates close to 5%. A very similar kind of dynamic globally, where you're seeing the European Central Bank and the Bank of England going from negative interest rates and trying to get them positive. So it's really been all about inflation. As Payal said, it's been inflation we hadn't seen in 40 years. And so the flip side to all this movement in short-term interest rates is interest rates overall have gone up dramatically here for the first 3 quarters of 2022, and it really was nowhere to hide. In fact, it was the first time on record of going back to the early 70s of bond indices where you had negative returns in both equities and in bonds 3 quarters in a row. That just doesn't happen, yet it happened. So interest rates just kept going higher and higher as the Federal Reserve began to telegraph to the market that they're not done with increasing short-term interest rates, and inflation continued to be a problem right up until last week, when we finally got an inflationary report, the CPI number, that actually showed that maybe we're peaking. So we've had a bit of a retracement, but when the smoke is cleared, you still have short-term interest rates up over 3.25%. You have long-term interest rates up 2%. You had total returns on the major indices at negative double digits. In fact, the Barclays aggregate, which is the largest index in the bond market, was down close to 16% less than a month ago. Today, we're down 13%. The municipal bond market, which was down around 15%, is down close to around 11% now. So we've had a bit of a retracement, but you still have this dynamic of short-term interest rates are now higher than long-term interest rates, which has usually been a pretty good predictor of upcoming recessions. And so now longer-term interest rates are kind of taking odds of how bad that recession is going to be. And so that's where we are today, is a much higher rate environment with short-term interest rates leading the way, and really carnage in the bond market and returns, negative returns that we haven't seen this degree in almost 50 years. So quite dramatic in the bond market here year to date, Wilson.
Sounds scary. Kyle?
Sorry, I have some distractions here. I apologize. So we do have some questions for you, John. How do we get to where we are today? What is the current status of the bond market from your perspective?
Actually, I just answered that, so you might want to go on to the next question. So,
I
yeah,
apologize. I have
no
distractions here. Sorry about that.
no worries.
What is your outlook of future inflation? So what are some additional downside risks to bond values if the Fed continues to hike up the rates?
Yeah, I think when you look at the bond market, you really take a look at, you dissect it into two halves. You have short-term interest rates and you have long-term interest rates. In a kind of an ironic way, I think the more that the Federal Reserve has to continue to increase short-term interest rates, the greater the likelihood that we won't have a soft landing. That is, we'll have a more pronounced downturn in the economy, which in an ironic way would mean that that is the catalyst for longer-term interest rates to go even lower. And again, we've seen a little bit here in the last couple of weeks. We're down about over 0.5% in interest rates on longer-term securities. And so the differential between 2-year Treasury yields, for example, and 10-year Treasury yields, 2-year Treasury yields are actually higher by about 60 basis points compared to 10-year Treasury bonds. The 10-year is around a 360, and the 2-year is around a 430. So there's this differential. We wouldn't doubt that the more the Federal Reserve in the coming quarters ahead has to move short-term interest rates, the greater the likelihood that we'll actually get a move lower, and maybe materially lower in longer-term interest rates. So inflation plays a huge part of this. We actually think there's components of inflation that could continue to be quite sticky, particularly it has to do with the housing market, because they use something called owner equivalence rent. And we think rents aren't coming down anytime soon. We think wages are going to continue to be up. So we think services is going to be high in inflation, but goods prices continue to go down. So our outlook on inflation is elevated longer than we would like. And the Federal Reserve with that will most likely continue to increase short-term interest rates. But as I said, in a kind of a perverse way, that means a greater likelihood for longer-term interest rates to go down in the quarters ahead.
Thank you.
Great, thanks, John. Can you explain the term real yield and if investors can expect this going forward? And also just in general, how would you advise your client in today's market?
Yeah, two really good questions there, Wilson. First of all, real yields, the definition of real yields is you're able to buy a fixed income security that is actually higher than the prevailing inflation rate. And in today's environment, that is not unusual, but today's environment, you have headline inflation, CPI, while it's come down a little bit, it's still near 8%. But the Treasury rates are significantly lower than that. Say 2-year Treasuries at a 440, as I mentioned before. So you do not have real yields in the Treasury marketplace. And the only way to get real yields, quite frankly, is to deteriorate credit quality pretty significantly in the fixed income market. Now, if you lock in today's yields and inflation goes down, you might be fortunate enough to actually get real yields in your bond portfolio, considering your book yield. And so, for example, if you buy bonds at, say, 4% and inflation goes down to 2%, then you will have a 2% real yield. But in today's environment, inflation again at 8%, you're still in a negative real yield environment in the vast majority of the fixed income universe.
Thank you,
What I'm
John.
advising clients, the follow-up question is, okay, how are we dealing with that? And what are we doing about it? Well, this year, we've been trying to keep our maturities relatively cautious and short. As interest rates go up, how much interest rate sensitivity you want in your bond portfolio, i.e. how long the maturities you want to put in your bond portfolio are important. We've allowed those maturities to drift a little bit lower than their benchmarks. But now, since interest rates have gone up, we're actually getting closer to our benchmarks. We're locking into some of these yields. So we think that these yields, particularly a month ago, and maybe not as dramatic today, did represent an opportunity. We haven't seen yields like this in 15 years. So we're advising clients is unlike, a year or two ago when yields were close to zero, you're actually finding decent yield in the fixed income marketplace. And there is an alternative to equities. There used to be a term called TINA. There is no alternative. And that means the yields were so low. Well, today, fixed income represents a much better option than it did a year ago. So we're telling clients to think a little bit more opportunistically or optimistically about what is the fixed income is going to be able to present, because yields, again, we haven't seen these yields in 15 years.
Great, thank you.
Yep.
Thank you, John. Our next question is, in this environment, how do you feel about holding bonds to their maturity versus active bond management?
Yeah, we firmly believe in active management. One of the key components of buying bonds is which ones do you buy? What kind of credit quality, for example? In a BNY Mellon's Wealth Management Group, we have 6 really seasoned analysts that behind the scenes are not only approving the bond before we buy it, but monitoring that credit quality. So a simple theme about active management is making sure that if you see something deteriorating, selling that before maturity. And there's all sorts of shifts and turns in the yield curves. That is the differentiation between yields and various maturities. And obviously, the overall level of rates are moving all the time. And so we believe that an active approach relative to a passive benchmark, or as you say, laddered approach, is a much superior way. One of the major themes that we're doing from an active management perspective this year is we're doing something called tax loss harvesting. So there is some silver lining. The fact that you have all these negative returns within your bond portfolio is we're able, as an active manager running billions of dollars for our clients, to substitute one bond for another that are very similar in characteristic. So just say, for example, we bought a 10-year bond a year ago, and now it's a 9-year bond. It's AA rated with a 5% coupon in the state of New York. Well, we'll today turn around and buy a 9-year bond with a 5% coupon bond, AA rated in the state of New York, just not the same bond. And so we're selling the bond at a loss, but going in and basically owning the same economic investment you did originally. You still own a 9-year bond, but you're able to harvest that loss, which in this environment could be as much as 10%. So taking that 10% loss, but not necessarily getting out of the bond market and staying in the bond market, that's an active management approach. And you can take those losses and use them not only in this asset class, but in other asset classes within an overall wealth management portfolio. So actively managing portfolios should not be a 4-letter word. It doesn't mean that we're churning dramatically. We're looking for opportunities. If you're going to a manager that you're paying an asset management fee, we always say we want to make sure that we're giving the value of that fee by modifying the portfolio, giving our outlook, looking for opportunities, and turning that portfolio over to make it in a more optimal position. As I mentioned before, one of the things we're doing recently is selling shorter maturities and buying longer maturities and locking in those yields. Another example of active management. And unlike the equity market, where the active managers really have a struggle beating the passive index year after year, if you look at the universe of active managers in the fixed income side, they typically beat their benchmarks. So there's a kind of a compelling case to take an active approach, have a passive approach within the fixed income market. And as I mentioned, a year like this is a classic reason of tax loss harvesting, which obviously you wouldn't do doing a passive approach.
So when would you consider municipal versus corporate or versus treasury bonds, especially regarding tax rates and where the bonds are held?
Yeah, really good question, Wilson. We advocate for our clients that the simple rule of thumb, don't put all your eggs in one basket. So even though a client may be in the absolute highest tax bracket, it would not be unusual for a BNY Mellon wealth management client to own only, to own not just municipal bonds, but to own some of those other fixed income sectors, because they don't always correlate the same. Sometimes municipal bonds go down more in price, sometimes they don't. So we like a combination of different strategies. However, the tax bracket will definitely dictate the degree of which you own municipal bonds or do not. It's typically a scenario where our highest tax bracket clients are going to own at least 80% in tax-free bonds. It produces the best after-tax yield equivalent, especially risk adjusted. Because if you look at the municipal bond market, the average rating is AA. If you look at the corporate bond market, the average rating is high BBB. And so from a risk adjusted yield basis, municipal bonds relative to corporate bonds look good. Obviously, municipal bonds relative to treasury yields look more compelling, but it doesn't mean, again, that we would say put all your eggs in that basket. I have no problem owning some corporate bonds, no problem putting in for our more aggressive clients strategies like a high yield or a floating rate taxable. A floating rate high yield, those are taxable securities. You're going to pay tax on those. But again, it gives you the potential to earn a greater total return because some of those are more risky, and it gives you diversification should you need it. So we do believe in diversification, but definitely taxes and risk tolerance are going to dictate what that asset allocation within the fixed income market looks like.
Great. Thank you, John.
You're welcome.
Thank you. Now that Fed rates have gone up, how do you think that will affect the stocks?
Well, yeah, that's an interesting question because there is a correlation between what they call the risk-free rate and the level to which PE ratios can go to. And the lower the risk-free rate, the more attractive PE ratios would look, even if they go up. But now risk-free rates are going higher. So theoretically, the stock market has to take that into account, that they need to offer a better price versus earnings outlook to be competitive against those short-term interest rates. So that was particularly prominent this year in the tech market, which is very sensitive to interest rates. As interest rates have been going up, the tech sector has been going very, very down. So it is that influence of a relative choice of investment that you actually need to, all things being equal, have a lower PE ratio the higher interest rates go. And so we've seen part of the adjustment in the capital markets was all influenced by the idea of the risk-free rate going significantly higher. And what I mean by risk-free rate, it's really the highest of quality of short-term rates, which again today would be something called SOFR, which is sitting around a 485. Remember, that started at about 15 basis points this year. So a big move higher. So that impacts the valuation outlook for equities. And obviously the decline in equities has something to do with that valuation correction.
Thank you.
Great.
You're welcome.
So now we'll go on to our final polling question. So you'll see it pop up on your screen. You could answer accordingly. And then we also want to open up for the audience to ask any questions. John, we have a couple questions. So I'll fire off this first one. Can you explain the rationale for why long-term rates may be expected to reduce as inflation remains high?
Yeah, that's a good question. What the market is anticipating is that inflation is not going to remain hard. And in fact, if you look at inflation expectations in something called the Treasury Inflation Protected Market, where you have billions and billions of outstanding Treasury securities whose coupon is influenced by the rate of inflation, that market is actually implying that inflation is going to dramatically go lower. Remember, headline inflation today is around 8%. The break even on a 2-year Treasury inflation protected security is closer to 2.5%. So what the market's saying is that they do believe indeed that all this movement in short-term interest rates, not only domestically but globally, will have the impact of slowing down inflation. So as that becomes, as that actualizes, inflation begins to go down, you'll see the dynamic of the potential for longer term interest rates to reflect that and go down with it. So I guess the market is basically betting that inflation is not going to stay this high. And that's, again, the scenario where long-term interest rates could retrace some of these big moves up they've made in interest rates here in 2022.
Great, thank you. We have another question here. It says, when I hear quotes for positive real yields on 10-year treasuries quoted on Bloomberg Radio, is that due to the current 10-year yield expected to be higher than the average forecasted 10-year inflation rate?
Yes, that's exactly what it is. It's basically saying that they think, again, as I mentioned, inflation expectations are supposed to go down to 2.5. And if you can lock in these yields for 10 years and inflation goes down to 2.5, you have a positive real return in your bond portfolio, which hasn't happened in quite a while. And so that's exactly what you're hearing, is that dynamic that even though today's headline inflation is at 8%, market's expectation is that to fall pretty dramatically. And if you locked into these rates, you could get a real, for the holding period of your bond or bond portfolio, you could end up with a positive real return.
We have one more question here. For clients anticipating the need for cash flow from bonds that may be in excess of the yield over the time, is liquidity of various types of bonds a consideration?
Repeat that question again. Say that again.
For clients anticipating the need for cash flow from bonds that may be in excess of yield over the time, is liquidity of various types of bonds a consideration?
Oh, yes, definitely. I mean, again, I mentioned before, we like the idea of diversifying. And for those clients that can tolerate a little bit more risk in their portfolio, even including what they call junk bonds, high yield bonds, emerging market bonds as an example, go anywhere strategies that may be able to boost your return away from the highest quality, more conservative mandates, which we kind of call the core. So we do believe in these satellites that I would call high yield, emerging market debt, opportunistic go anywhere strategies is more the satellites that can augment your yield. So we do have a lot of clients who like income and spend a lot of income and spend too much income in hopes that the equity market portion of their growth portion of their portfolio will offset the fact that they're spending more income than the yields are producing. That is, they're buying bonds at a premium. Let's say you buy a bond with a 4% yield that has a 5% coupon. The clients are spending all that 5%. And so they're eating into the principal in hopes that you can get appreciation in the other portions of your overall diversified wealth program or investment program. And part of that is taking other risks within the fixed income market. So I clearly believe in diversification in that core and satellite approach. How much you put in satellites is a function of the unique risk tolerance of the clients. But as a general rule, we probably wouldn't put in more than 20-25% in some of those more aggressive strategies. We do think fixed income for the nucleus of what you're doing should be for predictability, stability, and for liquidity. But if you could give up some liquidity and go into some of those more aggressive strategies over time, that has proven to increase your total return, increase your yield, and help our clients meet their yield targets.
Thank you, John.
You're welcome.
Let's see if you have any more questions.
Yep, there's a part 2 of that question, Payal.
Yep. Can you explain consideration other than tax rate that should be considered when choosing bonds? Any other consideration?
Yeah, absolutely. One is time horizon, right? So you might have a client who is just unknown as to when they might need a big portion of the money to meet some kind of lifestyle need or go buy another business or make a big purchase. So liquidity and time horizon has a big determination of what maturity profile, therefore what particular benchmark we're going to tell our clients to go in. Their history with investing. If they've only been buying CDs or sitting in money markets, we're going to be a little bit more conservative in way that might dictate what type of maturity profile there is. Their overall risk tolerance, how much they can stomach volatility of the underlying strategy is going to dictate how much we're going to put in some of those satellites, like a high yield or floating rate high yield or emerging market. Those are just, obviously other than just the tax bracket, the dominant, most prevalent kind of dictators of where we're going to be. The other is, again, how much income you need, right? So usually the curve is normally inverted, usually, and then we're not in an unusual time, shorter maturities give you less of a yield. And so in a normally, sloped yield curve, we'd be and that's true in the municipal bond market. The longer you loan out money, the more yield you get. So sometimes it's like a client has a certain yield target that they need, that might dictate the maturity profile. Those are usually like the classic reasons to consider various types of strategies, diversifying credit quality, going into non-investment grade versus investment grade, maybe even or putting some currency risk when you're looking at emerging markets to boost returns. So it's a combination of risk tolerance, time horizon, liquidity needs, all different than just the tax bracket.
Great. Thank you very much, John. Can you expand a bit on liquidity? I have a question here. Explain liquidity issues to consider when building a ladder if cash is needed between maturities.
Yeah. Some people like to immunize liabilities. That is kind of like ladder if they know they need a certain amount of money. Like, for example, a typical situation, a client sells a business and they know they have tax liabilities going out 24 months. A lot of times when we know it's that short of a need and time horizon, they need the money, we're actually going to immunize. We'll buy maturities on fixed income securities that match up to those known liabilities. If there's a high degree of uncertainty as to when that liquidity is going to be, that's going to dictate which particular benchmark we use, i.e. what type of maturity profile we use. If there's a high degree of uncertainty, for example, we might use a short mandate, say maturity ranges between 1 and 3 or maybe 1 and 5. If a time horizon is longer than 3 years, we're going to typically tell clients they should probably be in the 5 to 15-year maturity. Now, we mitigate liquidity risk by buying high quality rated securities that we stay obviously on top of to make sure the credit quality is what we want it to be. And usually denomination's large enough. As a very large fixed income manager, we take all our clients and aggregate them. For example, we own $22 billion in municipal bonds. So a lot of times we're going out and putting in huge orders for deals and then spreading those around in our clients' portfolios. That helps out the liquidity. So we might be selling, even though one client only owns 100,000 in a particular portfolio, we may be buying or selling in millions of dollars of bonds. So liquidity, either the liquidity challenge in smaller denominations is offset the fact that we're aggregating our clients' bonds and acting more institutional. We're giving our clients institutional execution, even though they own more of a retail or a separate amount. All of that helps with liquidity. So good liquidity in the names you're buying, recognizable names, rated securities, securities that trade relatively frequently, large deals help liquidity. We talked to over 100 broker dealers within the investment community and ask them for liquidity day in and day out. So we're constantly buying and selling securities to give our clients liquidity. But clearly, it begins with picking the right benchmark that coincides with what we think the liquidity demands are going to be. And if you're talking about, absolutely known outflows, it's typical that we'll immunize those outflows with exact maturities to meet those known outflows.
Great. Thank you. See if you have any more questions here. I do see one more question. Should older clients, late 70s, 80s, avoid individual bonds if expected withdrawal rate exceeds yields? Is active management more appropriate for clients with this profile?
Okay, I'm reading the question. Should older clients avoid individual bonds if expected withdrawal rate exceeds yields? Is active management more appropriate? Well, again, our clients are typically larger type of clients, and so it doesn't matter what age they are. They have big enough amount dedicated. So they like the benefits of a separately managed portfolio that's being actively managed. And remember, active management isn't just simply just buying maturities and holding. There's active management going behind the scenes. For example, credit quality. And in this year, tax loss harvesting. So there's always, I don't care how old you are, there's always a need to try to generate a certain amount of losses to offset gains that could be happening. And we're actually seeing it this year. Index funds are, a lot of them are actually producing more gains on the equity side than you would think, even though there's losses, because they had turnover on really low cost basis stock. So losses are a good thing. That's just another example. Again, I guess I'd say there's nothing wrong with using a mutual fund or a co-product. You just got to understand the differences. Our clients like to use separately managed portfolios because they like the transparency. They like to know what they own. And they like the concept that if they buy a bond, worst comes to worst, they could just hold that to maturity. It's not a perpetual entity like a mutual fund is. And you have complete transparency. You have also customization. of those separately portfolios. So they can say, I don't want to buy a bond beyond X, and we'll book a benchmark to do that. You don't have as that much transparency within a commingled product like a mutual fund. That's the typical disadvantage. You get really good diversification in a mutual fund, you get active management on that mutual fund, and you typically have better liquidity on the mutual fund. So again, our clientele are usually large enough that they prefer separately managed accounts, but there's nothing wrong per se of choosing a mutual fund versus running a separately managed portfolio. But all our separately managed portfolios, we would clearly advise them to actively manage that. And it isn't just a matter of turning the portfolio over. It's a matter of making sure that the portfolio is optimally positioned to outperform their benchmarks in all periods, rising rates, declining rates, credits getting worse, credits getting better. And so we think that it's well worth it to hire an active manager to do that and to kind of it's a lot of money for our clients to put resources to make sure you're doing it correctly, to do the best you can, and pick a benchmark to use a barometer of how we're doing. So it holds a standard of all these decisions we're making. Are they right or are they wrong? So we firmly believe in active management. And again, if the client's large enough, our experience is they typically pick a separately managed portfolio. And again, I would say do it active as opposed to passive.
Great. Thank you.
You're welcome.
Do we have any more questions?
I think that was the last one.
Yeah, I don't see any more questions.
Feel free to ask me, Wilson, you have any question, anything
Yeah.
else? I'd be happy to handle anything you guys need, even if you want to get away from fixed income. You know, one of my positions, I do sit on the investment strategy, so I have a very keen sense on what we're thinking across all capital markets and what asset classes we like or don't like. So feel free to ask me anything you want. I know it's only half an hour, but if we want to close it out here, that's fine too. Totally up to you guys.
Yeah, John, what's your thoughts on high yield?
Yeah. High yield fixed income is interesting. We recently in spring went from overweight, from years of being from overweight to neutral, because a lot of our clients like yield. You know, they want to have that income in their portfolio. And our outlook for the economy was strong enough. We've seen corporations improve their balance sheets. And what we mean by that is they've been able to extend their debt so they don't have short-term debt. And that has pushed out their liabilities. They're obviously making a lot of money. So corporate America is in pretty good shape, and even high yield's in pretty good shape. So we have been overweighted for quite a while, but just given the potential of an economic slowdown that we noticed in spring, we moved it to neutral. We're still evaluating whether or not we want to go underweighted, because in a recession, the actual amount of defaults on corporations who are in the junk area, the high yield area, which basically means below investment grade, which basically means by definition that your projected net income on a corporation is not large enough to meet their debt service liability. So something has to improve one way or the other. Either your liability's got to go down or your revenue's got to go up. And if that doesn't happen, then you could potentially go in default. So default experiences in a recession could be double digits. And in fact, expectations of default during the great financial crisis got 30% of the whole universe. So it's very, very extreme. Our default expectations in this particular recession, because we think it's short and shallow, is only going to be around 5%. And so typically yield spreads, and that is the difference of yields between Treasury securities and the average yield on a junk bond, typically widen, i.e. either Treasury yields fall or high yields go higher more quickly than Treasury yields. Treasury yields have certainly, those spreads on high yield versus Treasury yields have widened out and been a bit volatile, but not nearly as dramatic as what it typically would happen facing a recession. You get a normal reaction in high yield relative to Treasuries, and spreads would get to 800 to 1,000 basis points of difference. So putting that into English is to say the 10-year Treasuries of 4%, 1,000 would be high yield, would be it would be yielding 14%. That is, those yields would be going up and your prices would be going down more dramatically in high yield. This time around, we don't think it's going to be nearly that dramatic. And the main reason is that if you look at the composition of high yield fixed income securities, there's much more double B securities. Remember, the rating criteria for high yield bonds are below investment grade, which means below triple B. So it's double B, single B, triple C, and then dreaded D, which is in default. And so we think the overall credit quality today, because the earnings have been strong, because corporations have been able to extend their debt, they don't have to roll over a lot of debt, because corporations don't have as much floating rate debt and have more fixed rate debt, and overall earnings power has been relatively strong, that we don't think, again, it's going to be as bad this time around. But we still may say that now the high yield spreads are only about 450 basis points. A normal environment would be 800 basis points in recession. So how much upside do we have versus downside? So I wouldn't doubt over the next couple months that we might become a little bit more cautious. We won't eliminate the exposure. We'll still favor floating rate high yield, or bank loans as they're called. They're going to be much more pegged to short-term interest rates from a yield perspective. And they're typically higher in quality than the overall landscape of high yield bonds. So we'll still favor them, but we may actually come down a little bit because it's just a logical thing to do, that we don't think the market is actually priced in enough default risk as we look out to 2023. So we like it. I wouldn't overweight it. I'd be a little bit cautious with it and prefer floating versus fixed.
Great. Thank you, John.
You're welcome.
I think we have a few more questions here. Is there a general rule for tax rates over which munis are generally better than taxable bonds, or do the spreads vary enough that the analysis needs to be reviewed constantly?
Better than taxable bonds or spreads enough that analysis needs to be done. Review constantly. That's a good question. The answer to that question is it depends on the tax bracket, and it depends on the relative yield relationship between what we call AAA municipal bonds and treasuries. And as a general rule, the shorter in maturity, the less attractive municipal bonds are compared to taxable securities. So right now, for example, a 2-year AAA municipal bonds are around 70% the yield of a treasury security. So what that would mean is that if you assume that the credit quality in a AAA municipal bond was the same as a treasury security, and you assume the liquidity was the same, your break even would be 30% tax bracket. If you're higher than 30% tax bracket, then municipals would make more sense. If you're lower than 30% tax bracket, then they wouldn't make sense. You need buy treasuries or some other taxable fixed income security of like quality that would get you a better after-tax return. The further you go out on the maturity range of municipals, the higher the ratio is. That is, the more close the yield is on a pre-tax municipal bond compared to a taxable bond, which is taxable, like a treasury, a mortgage-backed security, or a corporate bond. The relationship in 30 years is at 95%, and times during the year it's got as high as 110%. That's right. You actually had scenarios where AAA municipal bonds were yielding more gross than treasury securities, which happens from time to time. And that all had to do with the technicals of municipal bonds and massive outflows of municipal bonds here in 2022, a record amount, over 100 billion in outflows. So way more sellers than there are buyers, basically. So today that would say in 30-year range that you'd be as low as a 5% tax bracket and be indifferent. So almost everybody's above 5% tax bracket. So municipal bonds for tax-paying, most tax-paying payers today would favor municipal bonds over taxable securities unless you deteriorate credit quality. For example, if you went into high yield, well, high yield offers a better after tax than does municipals. If high yield's yielding 9–10%, even at the 40% tax bracket, that looks relatively attractive compared to what you could get in higher quality municipal bonds. So we're constantly looking at this. And looking and having a determination whether we think municipal bonds are rich or cheap, and in what part of the maturity profile we think is the most optimal. I can tell you in today's environment, if you get out beyond 10 years, municipal bonds are really attractive. Inside of 10 years, not as attractive, but still attractive for the highest tax bracket. And what we'll generally do is if a client is close in tax bracket, it would be not unusual that we have a bucket of fixed income that's investing in corporate bonds. Maybe a smaller amount, maybe again, 10–20% of the client's fixed income assets, and the rest in municipal bonds. And so you're throwing off a certain amount of taxable income, which almost by definition may put you in a higher tax bracket because you're throwing off taxable income within the corporate bond portfolio. And we won't get it exactly. And sometimes those two buckets can change. If someone's outlook for tax brackets is going to be lower, then we might take some bonds out of municipal bonds and put them into the corporate bucket. In fact, I had a call today, a client who just does that. He had a $5 million portfolio over some muni bonds, and he had about $1 million bonds in corporate bonds. I think their taxes are going to be low this year. and they might take some money out of municipal bonds and put them into corporate bonds. You know, it's hard to project exactly what the tax bracket is. I'm telling you guys, you're in the tax business, so you can't get it exactly right. But we try to work with clients and think about taxes, not on a daily basis, but like more year to year. What do you think your taxes are going to be this year? What do you think your effective highest bracket's going to be? And then let's lean one way or the other between taxable and tax exempt allocations.
Thank you.
Welcome.
John, I do have a question because it was mentioned earlier. Can you explain what a laddered bond portfolio is?
Yeah, sure. A classic ladder is a client goes out, an investor goes out and wants a bond due every year. So they'll buy a 1-year bond, a 2-year bond, a 3-year bond, a 4-year bond, a 5-year bond. Most have been trained to go all the way out to 10 years, but don't want to go longer than 10 years. And as that 1-year bond, 1 year later comes to maturity, they simply take those proceeds and go out and buy a new 10-year bond. And so it's a ladder. You get every year you step out 1 more year, and you have, so your maturity profiles exact amount of principal for 1 year out to 10 years. So they call that a laddered portfolio. Everything is laddered the same. So that's really the classic definition. And in the municipal bond market, you see that again, as I mentioned before, the 0 to 10 part of the maturity profile of municipal high quality rated securities is probably the most overvalued right now. And that's because we are seeing a lot of laddering going on. Clients just like the comfort of not having to worry that much about interest rates because they always have a bond coming due within a year. And if interest rates go up, well, they take advantage of that going in there. We accomplish the same thing, but on an active basis. We don't wait around for the maturity. We may pick a benchmark that's the 1 to 10 year maturity, and we might favor, for example, 2 years more than 1 year or 8 years more than 10 years. Your averages might be the same, but they're not just passive. So typically when you think of a laddered portfolio, you think of a buy and hold passive approach. As I mentioned, we would advocate against that. If you have enough assets, the benefits of active management are clearly worth the effort in our opinion.
Great, thank you, John.
Yeah.
Let's see if we have any more questions here. I see one more question. What circumstances need to occur to have the aggregate bond index fully recover from its 16% peak decline?
Yeah, that's a good one. You need interest rates to plummet back down. If you want to get it done in the same amount of time, you need those prices to recover. You need credit spreads to tighten back in. Both I don't think are going to happen to that degree. So what you need to recover that 16%, quite frankly, is time. One of the silver linings for this increase in interest rates is now your reinvestment of monies coming back into the portfolio in the form of maturities or coupon payments are now going to be reinvested at higher rates. And so that higher rate new environment is going to increase the probability of better total returns in the quarters ahead and years ahead. So it could take a while, but eventually those higher total returns will recoup the negative 16%. Now, remember, prices go up and go down all the time. We're down now only 13% since we had a pretty good rally here, as I mentioned. Interest rates have fallen about 50, 60 basis points here in the last 2 or 3 weeks because of that just slightly softer CPI number. I keep saying, wait till we actually see bad economic news and what everybody's predicting. That'll really be the catalyst for a rally. But I don't think you're going to get down to a 1% on the, or 1.5% on the 10-year anytime soon. I'm more along the line. I can see the 10-year going to 3%, but not significantly lower. So unfortunately, I don't think within a year's time we're going to get there. If we are there, by the way, that's going to be really bad for the equity markets. It really suggests that there's something very bad going on with the economy, or there's some really bad geopolitical event going on. Think of something like China trying to attack Taiwan, or Russia expanding its military operations to include other countries, Ukraine. Something like that would be really, really catastrophic for the global economic outlook. That could create a big move down lower. but we don't think that there's a high degree of probability that interest rates are going to plummet that much. So unfortunately, it's most likely going to take time to recover the massive historical, like I said, really ugly returns that have occurred here in the bond market through the first 3 quarters of 2022.
Like we have one more question here. Are there inefficiencies such that when looking for, as an example, 2-year maturity, that one may choose, as an example, a 10-year with 2 remaining versus a recently issued 2-year bond?
I think the question is, there is a difference between buying a bond in the secondary marketplace that has 2 years remaining versus buying a bond in the primary market with 2 years remaining. Is that what the question is?
Yeah, I'll repeat the question. Are there inefficiencies such that when looking for, as example, a 2-year maturity, that one may choose, as an example, a 10-year with 2 remaining versus a recently issued 2-year bond?
Yes, there are some times you can find dislocations or inefficiencies between the secondary marketplace and the primary marketplace. That is an old bond that was originally a 10-year bond that's got 2 years left that you can buy at a higher yield than going and trying to buy a new issued 2-year bond. That happens all the time in the marketplace, particularly in the municipal bond market and the corporate bond market. Not as prevalent in the treasury marketplace, because the treasuries marketplace is a much more homogeneous marketplace. In other words, there's a much more finite amount of types of treasury securities out there, whereas the municipal bonds, there's 15,000 different issuers every year. And so there's far many outstanding smaller denominations, things like that you can buy in the secondary marketplace that makes it more interesting. So we take advantage. Sometimes the primary market or the new issue market gives you a concession, and sometimes it doesn't. So there's not a general rule to say the secondary marketplace is always cheaper. Sometimes it's not. We are open-minded to doing both, buy bonds that are in the new issue market or buy bonds in the secondary marketplace. For example, my team has over 12 professionals that just trade municipal bonds. We have 5 professionals that trade corporate bonds. So we have a lot of people watching those markets because they're over-the-counter secondary markets, right? So it isn't just the primary market. We're looking at the secondary marketplace. And so sometimes there's inefficiencies and sometimes it's the other way. And so I think it's important. Another, again, rationale for actively managing your bond portfolios is looking for those inefficiencies and dislocations and trying to take advantage of that and putting into our clients' portfolios that increase yields and give them a chance to have a better total return.
Thank you.
You're welcome.
One more question, John.
Sure.
When buying bonds at a discount, do taxes paid on the discount change the metrics for choosing munis versus taxables?
Okay. I love that. That's a tax question. All right. Yes, the answer is yes. For municipal bonds, there is a tax law that was created in 1994 called the de minimis rule, and it's rather technical. Think before 1994, a bond investor, let's say the prevailing rate on a 10-year bond was 5%. An investor could go buy a 6% coupon bond, pay 110 cents on the dollar, and take that 6% cash flow and avoid the ordinary income rate of taxation, 40%, let's call it. He or she could correspondingly go buy a 4% coupon bond at 90 cents on the dollar and take that accretion of that bond, that is that 10 points, 90 cents to par, and use that as a capital gain. The IRS in 1994 said, if you're going to avoid ordinary income tax on the 6% cash flow, now if you buy a bond at a certain threshold of a discount, that discount amount, whether you sell it prior to maturity, is now considered ordinary income. That 10 point become an ordinary income and not a capital gain rate. And so when you're buying bonds in the secondary marketplace on discounted municipal bonds, you may have to take that calculation into consideration and take a further discount off to reflect the fact that the accreted amount is going to be charged at an ordinary income rate, not at the capital gain rate. And so whenever we're buying discounted bonds, by the way, it's only in municipal bonds, not in the corporate bond market or the treasury marketplace. You always have to figure out what the true after-tax yield is, taking into consideration that tax liability is sitting out there that they're going to have to pay ordinary income as opposed to capital gains on it. So it's a little technical. It's been going on since 1994, and normally it doesn't pose much of a problem because why? Because interest rates have been so low and going lower for so many years. But this year, there is a large universe of securities that are subject to this de minimis rule, if you will. And so we're constantly having to look at, do we want to buy that bond and pay that tax? As a general rule, we've tried to avoid the de minimis impact by buying bonds at a premium and profiling higher coupon bonds. So if interest rates go up, your bond or bond portfolio would be more immunized from that additional volatility and the negative consequences that that lower dollar price presents. Again, that dynamic, the higher interest rates go, the more of a discount you have to take off that discount to reflect the new tax liability. And I know this is just only language that tax people could enjoy and appreciate. But there's this, nuance called the de minimis rule. And again, it was on the Reconciliation Tax Act of, I think it was 93 or 94. But it's really, really prominent in today's rate environment, particularly if you have old coupons, issued were 2 or 3, and now the prevailing rate is 4. There could be examples where the prevailing rate on a premium bond would be 4. The discount has to be as much as 4.5 and maybe even 5, depending on the maturity of those low coupon bonds. And it's something that we analyze all the time.
Nice.
Again, really technical. I apologize. There's no easy way to answer that question, but somebody obviously out there knows a lot about that scenario. And if you have anything to do with taxes, tax accountants, they're very familiar with what I'm talking about.
Thank you, John. Thank you very much. Thank you once again for going over such great information with us. And once again, thank you everyone for joining us today. If you have any questions or need additional information, please feel free to follow up with your BNY contact. Thank you.
Thank you. Thanks, Sean.
Thank you for having me.